Welcome back to the Max Your Dash podcast. Thank you for listening, liking, and sharing. I am your co-host, Steve. I'm here with Nate Elvers and Mark Temperato again. We're talking about the stock market and the economy today. Everyone's favorite topic. Mm-hmm. Isn't that right?
Yes.
Mark's not stressed at all.
Quickly, my least favorite topic.
I mean, there's a lot on the plate.
There's a lot. What do you think these conversations are going to be like when the market isn't volatile and it's just we're smooth sailing? Like, what do we even talk about?
Football.
You think?
Sports.
Yeah, stuff people want to talk about.
When was the last time that it was just smooth sailing?
2019, before 2020?
No, 18 had a bad end of the year,
that
too.
End of the quarter four, which year was that, 2019?
I think that was 18.
Quarter four was crazy.
But, like, I'm remembering 2019, 2018, that, like, people were all worried about U.S.-China trade stuff.
Yeah.
And, like, is there ever a time where there's not something?
Right. There's always something to worry about.
Drama.
We'll be able to have some drama usually to talk about.
We got some drama to talk about today.
We do.
Yeah.
But let's start with the good stuff. Max Your Dash moments. Mark's got a good one. This one's easy for Mark.
Real easy one.
Low-hanging fruit.
I usually talk about bourbon for my Max Your Dash moments. This one's easy. This past weekend, we celebrated Enzo's first birthday a month late, almost 3 weeks late. So that was a lot of fun. He's doing some walking around finally. It's not, I wouldn't say that he's walking, but he's taken 5-6 steps. So it's cool to see that. It was a lot. You guys were both there. It was probably too much. Won't be doing something like that maybe ever again, but it was a
lot of balloon popping.
Now it's behind us, which that's probably the best part.
I don't think it was too much.
Why did you
Well, it's probably too much for you.
I hated it.
Yeah, you're a weird person.
I hated it.
It was not too much.
I would rather have pizza and wings and watch golf.
Well, I thought it was at your house. I was 2 hours before. I was like, dude, how are you fitting all these people in your house? I said to the other day, she's like, it's not at my house. No, it was good, dude. I think it was fun. He'll totally remember it too.
Yeah, right.
It was so funny when both of our sons were in that ball pit.
Oh, that was awesome. that was funny.
I'm always afraid that Grayson's just gonna like punch him in the face or something.
I mean, my best guess is that stuff's happening at daycare anyway.
Yeah.
So
You're up, Nate.
All right, I'm going with like kind of a little moment that I it's one of my favorite times of year. I love this time of year. So I live out in the boondocks, obviously, and you guys, I don't know if you notice this, but this time of year, once the weather starts to warm up, and you get like those days in the 50s and the sun pops out, you get all the birds start chirping. Like, I love going outside this time of year, and it's like winter's done and you can hear the sounds of nature again. I love that feeling.
Not to interrupt you here, but this happened a couple years ago. You might remember it. Foxes at my house.
Yeah, the screaming.
Dude, screaming outside of my house.
Yeah, it sounds like someone's getting attacked.
Yes. I thought there was like someone dying in the woods.
I think it might be their mating season.
Screaming.
Do you still do your morning thing? Like you wake up, you go outside?
Not like this time of year, but once the garden is planted, which will happen in probably like late April, May timeframe, then yeah, got to go out, got to weed the garden.
You have the cup of coffee?
Cup of coffee. Maybe throw on some country music.
It's so weird how different our Max Your Dash moments are. That would not be a moment for me.
But when you live around here in upstate New York and the weather finally turns, it is a great feeling.
Yeah.
We're there. We made it, I think.
My Max Your Dash moment, my pops had his like semi-annual physical yesterday, and I took him, and it was his goal from the last time to go there to lose a bunch of weight, and he lost 50 pounds.
50?
50.
Is he on the pizza diet
He was
too?
super excited. No, he's not on the pizza diet. But we did have some pizza to celebrate. But it was cool to see him like right around Christmas time. He's like, I just got to get this stuff on track. My next physical appointment is in March. I want to lose. His goal was to lose 20 pounds.
That's
and
awesome.
he left, and they let him. And
You said 60?
50.
50? In how long?
3 months.
Wow.
Was it like mostly from
He
diet?
crushed it. Yeah, my mom is like huge into that stuff. It really was just about like, you know how this is, just replacing the foods he was eating just with better types of it. Because like, you know, all the food that you can eat now is just like crap. So, but that was cool. Seeing someone that you care about accomplish a goal is cool. Cool. Max your dash moments, check.
Yep.
So we're brainstorming what we want to do for these market commentaries to our listeners, guys. We kind of, I feel like, have been not all over the place with them, but like there's so much going on in the markets like we talk about. We may kind of seem scatterbrained, but we want to make this as valuable, short, concise, and pointed as possible. So what we're going to do is try to do market commentaries once a month. And these episodes are going to be, what do we think is the most important data that you should be aware of in the last month? So essentially what has been happening in the economy and the stock market. We're going to make it digestible for you. And then how does that impact you, right? Because a lot of people might hear this information and they're like, okay, that's great, but how does that impact me? I think that's what people want to know. What should I be thinking about? What's the most important things that happened? And then what does that mean for me? And that's all we're going to talk about. I think that's what we've decided is probably the best way that we can provide value, is to bring the best information that we think is the most important and then say, okay, what does this mean for you though?
Yep. So
that's what we're going to do today. We're going to run down the list. We got our handy dandy portfolio manager, Mark, with us. So do you want to talk about year-to-date returns you want to do for markets, Nate?
Yeah, let's kick it off with, let's just talk about where are the markets at so far year-to-date. So we are basically wrapping up Q1, and I'm just going to touch on the big ones that we really pay attention to. So starting with the S&P 500. Year-to-date, we're positive, about 4%. This is as of the beginning of this week, so not including...
It's March 28th.
Yeah, today's March 28th. So this was as of March 24th, I believe. So we're positive year-to-date, S&P 500. The NASDAQ is ripping, positive 13%.
Ripping.
Year-to-date. It's interesting to see the difference between growth and value, Mark, year-to-date. So growth is really outperforming value significantly. In the large cap sector, growth year-to-date is up 10.7, where value is actually down 3. That's a big shift from the last year or so, where value really outperformed growth last year. So, and then the bond market across the board is positive.
Yeah.
Which is good news. Last year, the bond market was negative across the board, which is what made last year really challenging for investors, not having really any safe money to yield anything. So bond market's positive, S&P's positive, NASDAQ's positive, but certainly volatile.
Yeah.
And there's plenty of bad noise out there that we're going to get into today. But it's interesting to see year-to-date positive numbers.
Yeah. We always preach at Dash Capital to zoom out. Any good money manager, I feel like, says that, but zoom out, because like those day-to-day fluctuations, especially nowadays, stinks. But like hearing those numbers, even for me, I'm like, wow, not too bad. But some days, like when we're asked like how the market's doing today, just probably shouldn't, you know what I mean?
No.
It's just like a lot. Those day-to-day fluctuations are just a lot, but you got to zoom out and see the bigger picture. So first data point, rate hikes. So the FOMC meeting was last week? Was it last Wednesday, Mark?
Yeah.
Okay. And they raised rates again.
Another quarter point rate increase. Do you ever wonder why this is a range? So they're now between 4.75 and 5. So if you take the average, it's like 4.8.
Oh, yeah, no.
I don't understand why they do that. So the target range is between 4.75 and 5%. Which is crazy. I mean, that, coming from zero, about a year ago? It started last February, last March. So going from 0 to 5 in a year is a lot, and it's fast. They probably should have done more in the beginning. You know, reflecting is easy to say that. Hindsight's 20/20, but yeah. So
how does the Fed keep putting the foot on the gas and hiking rates? How does that affect our listeners?
Well, so one thing to, I guess, look at now. So it was kind of a dovish, meaning like sounds like they're either done or near done with raising rates. So if that is the case, if they're done raising rates, or near done raising rates, I don't think you should just assume that they're going to start cutting rates, right? That just means that we're in a spot where they may not have to do, the Fed may not have to do anymore. But another thing we were reading is that the lending is going to become harder to come across now. And that actually is doing some of the Fed's job. So if they tighten up lending standards, that is going to tighten up the amount of money that's going out into the market now. So hopefully helping inflation there too. Sucks for small cap companies, but yeah. So if they may be done, but some of that is due to the banking collapse, which we're going to talk about in a little bit here.
Yeah.
Or not collapse, but SVB. But yeah. So I mean, what was your?
I think it was like, how does it impact them? I think the biggest thing is you probably can, obviously, it's not always, we don't know what's going to happen, but you can probably expect the longer the Fed continues to hike rates, the longer the market's going to stay volatile for the most part.
Yeah.
Yeah.
I think it's important too to point out, right? So the main problem that needs to get solved is inflation. And I feel like that's really important to emphasize to our listeners, like, because I often have the thought, and I think I've even said it on this podcast, like, why is it more important to solve this inflation thing if it means sending us into a recession, if it means people are going to lose their jobs and stuff like that? Why do we have to tackle inflation above all else? Is I think an important thing for people to understand. And so the Fed has been raising rates to tackle that one issue. And when you see things like the banking stuff going on or whatever, and you're seeing a lot of blame being put on the Fed or whatever for causing some of this stuff, it's still more important to tackle inflation than it is to fix anything else.
Yeah.
Why is that though?
I mean, it's already been happening for I don't know the exact number, but when inflation is outpacing wage growth for this long, people can't afford this. And you see everyone's been talking about it. We've been talking about it. It's just everything you do costs a lot of money. And it's getting to a point where it's become a problem. And if you don't get that under control, people are screwed. You're going to see defaults on their mortgages. They're going to not pay their credit card bill, bankruptcies on the rise. So, we need to get inflation under control, and ideally wage growth needs to be at least on par with that or higher. I think it's also important to understand that the pace is slowing, but prices are still going up.
Yeah.
So, this is going to be painful for a while now, and until we see, which I don't expect this, but negative inflation or deflation, like that's unlikely. We're not going to see that like anytime soon here. Just a slowing pace, and hopefully wages catch up to that.
Yeah. Yeah, I think that's an important thing for people to understand is like the inflation outpacing wage growth really creates big long-term problems where you're going to have a giant part of our population not being able to buy anything of significance, a home, cars, whatever. Like the lower to middle class demographics really struggle through high inflation periods. And that's like the heartbeat of America.
Can't afford your goods, let alone save money.
Right.
Like it's impossible. So you just keep falling further behind.
You have to start to see, and this is the thing that's interesting, is when you see this stuff happening with like the banks, and maybe we transition into that a little bit. It sounds really, really bad, right? It sounds really bad, but it's actually in a way probably a somewhat of like a good sign that it's working what the Fed is trying to do, right? They're trying to make things, we need to cool off the economy. Like we cannot be having things run this hot for this long because the wage gap in this country is going to get completely lopsided.
Yeah, I think our listeners need to understand that the Fed wants the economy to cool down. It's been too hot, and that's why inflation has gotten out of control. So their solution to that is to make the economy worse, and that's through rate hikes. So like worse economic data is what the Fed wants. Right. If we still have hot economic data, the Fed's going to still keep hiking, and that means that markets are still going to stay volatile. Yeah. Their ultimate goal is to bring down inflation.
Yeah.
But yeah, the SVB, I think that's a good transition. That's why this FOMC meeting, I think, was like, you guys ever see that joke on Twitter? They're like, this is the most important Fed meeting until the next one. Because everyone just freaks out. But this one did feel like it was kind of like everyone was holding their breath a little bit more, because it was preceding it was the SVB stuff, and they were like, are they going to pivot so everyone doesn't freak out? Are they going to still stay the course? And it was interesting to still see the Fed stay the course, even though you said they were a little dovish, right, Mark? They still ended up hiking, or some people might say they might have not hiked at all, or they might have reversed. But I think it's really important that the Fed really cares about managing expectations and the market taking them seriously. I don't think it really matters our opinion on that, but I think that hiking there might have probably been the good decision. And like, imagine if they had like pivoted and actually lowered rates after what happened, and like, what would that have done? But I think that meeting made people feel like that was more important because of what happened with SVB and the banking crisis or whatever is going on. But like you said, Nate, it's interesting because like that stuff happening is bad, obviously, but that's good for like, maybe this stuff's like kind of working. Yeah. You know what I mean? We just don't want to break it.
Right. You don't want to break it too bad.
Yeah.
And so let's talk about what happened with the banks for those people that maybe don't understand. Let's try to keep it really simple. So Silicon Valley Bank, SVB, they're a unique bank where a giant majority of their deposits are over FDIC insurance limits, right?
What's FDIC insurance limits?
So if you have a bank account, savings account or whatever, you are FDIC covered up to $250,000. Silicon Valley Bank primarily serves the technology companies that exist in Silicon Valley.
Yeah.
You know, so you imagine like those businesses have much more than $250,000 in checking.
Essentially, your money is insured. If something happens to it that's out of your control, you get your money back.
The government insures you up to $250,000. Now, one question is, why does a business bank account have the same insurance level as like a personal savings account? That doesn't really make any sense. That seems like an easy fix, but we're not the people in charge of that decision. But anyway, so what happened with this bank in particular, again, they're a very unique bank, is that they had to write off, like a lot of banks will have to, write off losses from bond positions they held, which I don't think we need to get too far in the weeds on that. But that's actually like probably was somewhat expected. Like they're not like every bank probably has to do that. But this bank in particular had to make a big write-off, and it freaked out their customers. And then you start to get the headlines out there that is SVB in trouble, and you get this run on the bank issue where all these businesses are trying to get money out that are over those insured limits and move it to other places, which is a rational thought as a customer. Again, and why it's so unique to Silicon Valley Bank is that like 88% of their depositors were over those limits. By comparison, like JP Morgan or Wells Fargo, only 37% of their accounts are over FDIC. So like this bank was really serving a unique group of people. So they start trying to move money out of there. And then the media just runs with this, right? Like what a better, like, can you get a better story than a run on the bank?
Overnight just collapsing.
So it creates this panic and fear, and, you know, people are moving their money around to protect their money. And again, I don't think that's an illogical move if you're well over those limits, but it's definitely being overstated, like how severe of an issue this is. But run on the banks really are a severe issue. Like if everybody in the country is trying to pull their money out, that's not good. But it gets caused by panic and fear caused by the media.
The way that I think you said that perfectly. The way that I understood it too is a perfect storm of stuff. One, them being a unique situation, but one, all of their current depositors withdrawing their money, and then they weren't getting any new customers either. So it was the combination of them not getting new people putting money in, and the people who did have money at their bank were just freaking out and leaving. So it kind of just, it was a perfect storm of stuff, like you said, with their situation.
And they made mistakes. There's no doubt about that. But it's definitely like a little bit, I would say, just, what's the word, where the media is just making it sound so awful, like the sky's falling.
It's hysteria.
It's a clickbait game that we live in today. So,
did you guys field any phone calls about that when that happened?
What?
Did you guys field any phone calls about that when that happened?
I've had a few. I've had some people say they don't trust the banks. They don't trust the government. Look, I think this all just kind of blows away with a little bit more time.
Yeah. Well, I think the main takeaway of this is maybe like some policies are updated and stuff like that. You know what I mean? From an FDIC side of
Which
stuff.
that's good.
Yeah.
That's actually a good outcome, I'd say. Mark, do you have any thoughts on that?
Yeah, I mean, it's again, like you said, they kind of had to see some of this happening where, when rates are super low, especially for their clientele, it makes sense for them to go borrow money and leave their money in the bank, right? Because they can grow that money on that debt faster, higher than the interest rate that they're paying, or faster than the interest rate that they're paying. So instead of them going and borrowing money, they started to take their money out of the bank because it's significantly cheaper to do that than to go borrow more money and put it, and then put that money to work. So some of it they had to see coming. So there's mismanagement there. Did the Fed? You can look at it from both sides. Did the Fed cause this to happen? I guess, but also mismanagement at the bank caused this to happen too. How did they not expect rates to go up? Right. Everything was telling us rates were going up.
Right.
So why would they go out and buy long dated securities?
But one of the things that I wonder, and I don't know the answer to this, like when you're a bank or a lot of financial institutions, insurance companies, pension funds, whatever, are you required to have a certain amount of money in certain asset classes like long duration bonds? You know what I mean? Like there's so much regulation. So like they're just screwed then.
Yeah.
Every bank is. Now, I want to be careful. They're not screwed. It's overstated. These losses are not going to crumble any of these banks. But once you couple that with bank runs, now they're in trouble.
Yeah.
So like every business, like you're seeing, Salesforce do layoffs and their stock price is just going up. Like this, it seems to me that in the banking sector, it should have been just very widely known and expected that they're going to have to write off losses on long duration bonds.
Yeah.
Like that should just have been expected that it's going to happen. You don't need to freak out and move all your money out of a bank because of that. It's just part of the process. It's part of the damage that comes with tackling this inflation issue.
Yeah.
So, I mean, one interesting part about this too is because they technically didn't have to lose any money, right? If they held them to maturity, they would have gotten all their money back and plus interest. If rates start to come down quickly, if that were to happen, like all of this stuff, they sold all these things at a loss, caused a ton of panic out there for no reason if rates start to come back down, or at least they would have had a lot less in losses.
Yeah.
That's kind of interesting to think about.
Yeah. But also, what if again, we don't know this because we're not on the boards of these banks seeing the data, but like what if you're looking at your balance sheet and you're saying, hey, we're getting 3.5, we can actually get 7 right now. Let's sell this. Yeah, we got to take a loss, but what we're going to gain as a result of being in the 7 over the next 10 years outweighs that. That's just a smart decision. But then you're a publicly traded company that gets announced to shareholders that you're taking this loss. It freaks people out. The media runs with it. Bank run happens. You're in trouble.
They don't have any choice either. Like if people come to the bank to get their money out and there's no money there, they have to sell stuff to get to raise that money. So, and I think that's why the Fed stepped in.
Yeah.
Ultimately.
And that's a good example of like the government and the Fed doing their job. Like that's what they need to do to make sure that we don't all.
Yeah. So I think those are probably the two biggest things that we're going to go into CPI here, but those are the two biggest things that happened this last month where the FOMC rate hike decision and SVB, those kind of go together. But the biggest impact on that, just like broadly stated, is just there's probably going to be a little bit more volatility in equity and capital markets still because of that stuff.
And I would say if you're thinking rationally and you're detaching your emotions, as you see things like this happening, remind yourself that, oh, wait, this is good because it means it's working and we're getting closer to getting to a better place.
Yeah.
Like when you see stuff like there's just I don't personally think that there's like an easy path forward here, right? So the more damage like this you see, I think is actually good for us getting out of this mess.
The Fed's job is to just make sure, like juggling the plate of making sure it just doesn't break beyond repair. But they got to make things feel worse for this problem to be fixed. But let's talk about CPI, the reason why all this is happening. How's inflation data look, Mark?
Well, it got better. I wouldn't say. I mean, January's report was kind of bad, right? It ticked down year over year from the December report, but there was a lot of stuff in there that did not look great. However, February significantly improved from there, and in a
Improved meaning inflation went down.
Year over year numbers. Well, core stayed the same, 5.5% year over year, and then headline CPI 6% year over year compared to January at 6.3% year over year. So slow. The pace is continuing to slow at the core level, at the headline level, and then the underlying part of that, I think, is what people want to know about, right? Where it's slowing. Where am I actually going to feel this? So before I say that, first off, understand that prices are still going up, right? Just at a slower pace. Inflation is not, we're not in a deflationary environment. So that's a good sign. Shows that what the Fed's doing is working. It's taking a long time, but it's working.
So what do you think about my grocery bill, though?
Grocery bill, nope. We had a little uptick, but at a slower pace from last month. Okay, food at home increased at 0.3% month over month compared to the previous month, 0.4%.
Cool.
So a little bit of a downtick there. Maybe we'll get to flat here at some point in the near future. It was up to peaked out at 1.3% and has steadily been falling since July.
Does it show year over year on like food?
No.
Just month over month.
No, I think this is just month over month.
So you said 0.3 month over month. So is it fair to say, like, if that pace continued, it'd be the next year would increase by 3.6%, which is closer and closer to the target of 2, right? Mm-hmm. So that is a good sign.
Yeah. Well, I guess theoretically we need these numbers to be at like what, 0.2, right. 0.25, something like that.
Something like that is where you want to see.
Yeah. Yeah. So one area where we did have deflation was in energy prices. So utility gas negative 8.8% month over month after a spike of positive 6.7% in January. So that's a big correction in the other direction. I don't think I'm surprised about. I don't know if you guys are surprised about that, but January data is coming in the coldest months of the year usually, right? So that's. Seeing a spike in utility gas makes sense when people are heating their homes more. And then now that we're getting out of winter and heading toward, so we're in spring officially, no surprise here that utility gas prices are dropping. But where we're seeing kind of the worst data is still in shelter core services. Those increased more than the previous month. So shelter prices increased 0.8% month over month. Rent 0.8% month over month compared to 0.7 in January.
What's that all about?
There's nowhere to live.
There is nowhere to live, quite literally.
Too many people chasing too few homes and apartments.
Yeah.
And it still surprises me because of where mortgage rates are at.
Right. People need, at some point, that it has to tick.
Maybe
people
they'll turn
to
all these commercial real estate buildings that'll never be used again into like apartments.
Mm-hmm. Yeah,
fix that issue.
So what does the CPI data mean for our listeners, Mark? It's getting better. A little bit though.
Yeah. I think that they obviously still raised rates, which means they don't feel that it's under control. If SVB didn't happen, there's a likelihood that they would have went higher and there would be more coming. But it did happen. So maybe there's less coming ahead of us, and inflation seems to maybe have peaked. We were talking about this earlier, but the drop in the 2-year. So when the Fed raises rates, it's a short-term interest rate hike, right? If you look at where the 2-year Treasury was at the beginning of the month on March 3rd, it was at 4.86%. As of March 27th, 3.76%. So it dropped an entire percent in a month, which is crazy. So, what was it? Historically, when the 2-year Treasury is lower than the Fed funds rate, which it is right now, that is a signal for the end of rate hikes. So this is, going into the market side of things. Also, historically, when the 2-year Treasury, when the rate hikes are behind us, the S&P 500 average return after the last rate hike, 17.6% historical average return.
Look at that.
So if that was the last rate hike, the on average, 12 months following the last rate hike, 17.6% to the positive in the S&P 500.
I don't hate that.
If CPI is continuing to fall and get into a more normalized range, it means that things should feel more affordable as long as wages are starting to, continue to grow at a decent pace, which they've started to decline. So
what you're saying is two things: is CPI data gets better, meaning inflation goes down.
Mm-hmm.
We should expect, hopefully, at some point, capital markets to turn green.
Mm-hmm.
But then also, you should see some better affordability things on purchases.
Yeah, I think things will feel like
eventually
you won't notice the increase in prices as much. Let's say it that way,
right?
Because they are continuing to increase at a slower pace, so you won't notice them as much as when you go to the grocery store, or gas station, etc., where you spend most of your dollars.
I think it'll be interesting to look at the data of when this cycle is done, what this rate cycle looks like, this rate hiking cycle looks like compared to the other ones.
The 70s?
Historically. ChatGPT, what they going to say.
Looking at that.
Yeah.
What was that? What did you say?
I'm saying like it'll be interesting to see the data compared to like when this is all done, what the data looks like compared to the other rate hiking cycles. Because this is what happens.
I think it's a good point to bring up. Like one of the best things to do as an investor is to zoom out and get perspective. Like Steve and I were messing around earlier looking at the data from 1970 through 85, what the Fed funds rate was and what CPI was. The Fed funds rate in 1981 was 16.39%. Can you imagine that?
When we say Fed funds rate,
triple.
that's what we mean when we say rate hikes, is that's what they're manipulating.
Yeah, and like we were looking at it, CPI in 1973 was 8.7 year over year. Then it went up to 12.34 in 1974. The market in both those years was down more than 15% consecutively, down 15 in 73, down 26% in 74. Imagine how you'd feel in that moment, that year, where CPI has now been going up for years in a row. The Fed funds rate's over 10. The market's been down consecutive years terribly. How awful do you feel as an investor? Well, if you took your money out, in 1975, the S&P ripped 37.2%. In 1976, up 24%.
Yeah.
It's like and we bring up in a lot of episodes that, what's that study that always gets done every year where they compare how investors do?
The Delbar study?
The Delbar study. It's so obvious, like, but it's so hard in the moment.
Yeah.
And we're not even, as we started this episode, we're positive across the board on most of the major asset classes year to date. But that could turn, inflation data comes out bad again, the markets drop, you're going to feel even worse. There's all this drama, the banks, this, that.
Mm-hmm.
It's so easy to take your money out. And then guess what? You miss out.
Yeah.
And when do you get back in? 2 years later, because you got FOMO.
Mm-hmm. Don't miss the best days.
And you missed all the best days.
Wonder what that grocery bill that year was like. I think it was like $25 for the whole cart. Like when inflation's that high and they're freaking out.
From like
what was a grocery bill
$15.
like in 1970?
A lot less.
Listen to this. CPI in 1979, 11.22 year over year increase. 1980, 13.58 year over year. 1981, 10.35.
That's crazy.
We aren't even close to those levels.
Yeah. No.
But it feels real bad.
It does.
Mm-hmm.
Perspective. I think those are good points, guys. Let's not overwhelm our listeners with too much, but that's what I would say is the most important stuff. The FOMC meeting, the rate hikes, SVB was obviously the biggest headline one, and then CPI.
Mm-hmm. Yeah, I would say, just we're talking about markets and investing as part of this conversation too. I don't think we're out of the weeds yet.
Mm-hmm.
I don't think you just go buy risky companies right now. Like you were talking about, Nate, the market returns year to date, large growth specifically has done really well, right? Outpaced everything else by a lot. But you're not seeing that movement in the small companies. So that's showing us more of a flight to quality growth companies versus just buying risk assets and hoping that they grow by a lot because they were beat up.
That's a good point.
I do think part of the reason why growth is up so much this year is because of how badly it got beaten up last year, and specifically large growth, a lot less risk than small growth. So people are starting to buy those companies that, you know, are safer quality companies in the growth space because they can. It's a lot less risk now to buy them. They're buying them at a discount from where they were last year. But
I just thought of a funny thing. You know, like those sayings like, don't be a negative Nancy. We should start a new one, like, don't be a panic Pete.
Don't be a panicky Pete.
Yeah.
Don't be a
What's a good name for that?
you panic Pete. This is up my alleyway.
Don't be a panic Paul.
Don't be a panic ball.
Don't be panic Pete.
one interesting thing, I mean, looking at where I'm going to be honest with you, I don't really think that it makes a whole lot of sense that growth has done this well this year compared to value, because it is still pretty expensive compared to value. So I'm still liking value as a play, as an overweight right now.
Look at if everything in the market just made sense, it'd be real easy to be successful. That's why you got to just be diversified.
Stay the course.
Stay the course.
Dollar
cost average.
If you're a listener and you are a client of ours, like we said, we are recording this March 28th. You hitting your inbox in the next couple weeks will be Dash Capital's quarterly investment memo. So if you like hearing us talk about markets and what's going on, but also what that means for your portfolio, we break that down every single quarter, changes. Like we essentially do what we did today, but more in depth. So if you're a client, just a reminder that we'll be hitting your inbox. We really urge you to read those just so if you want to know what's going on. So that should be hitting your inbox in a couple of weeks. But we aim to do these once a month, take the key data points. How does it impact you? We want to make sure that you guys know what's going on and digest it. We also do every Tuesday, we do a quick post on Instagram, talk about what's going on in the market. We send out a market commentary. We're going to link in the description below our market commentary that we send out every single week, which essentially is the prior week, what happens in the market and what does it mean for you. So we're just all about giving out resources like that, just because we know, especially like we're talking about in the beginning, my gosh, just Mike, all the drama, you know, everyone wants to know what's going on. Could you imagine like you're getting home from work, long day of work, and something's happening on the news and you're like, what do I do? What do I do? And you just don't know. Like that's stressful, you know? But do you guys have anything else to add?
No.
Mark?
I don't think so.
Okay. Sure. Last chance.
I mean, I don't know if we want to.
No, don't.
No.
No.
Okay.
Yeah, we're good.
All right, guys.
This looks good.
Thank you for listening to the Max Your Dash podcast. We will catch you in the next one.